This is a talk I'm actually working through right now, so I'm working on the deck for it. So you guys get to be my guinea pigs. I hope you guys are okay with that. But there is no presentation. It's actually be whiteboarded. And they're recording it, so you will get that afterwards. What was your name?
Dragon Slayer.
Dragon Slayer. All right, great name. Nice and memorable. There's, yeah, totally.
As the lady at the reception told me.
Yeah, there's I forget who Floodgate. I forget the name that they have it, but they have something like dragons or like thunder lizards. I think is what the name that they call for their founders.
In 2004 when I went to Apple for a customer meeting. They were a customer.
Nice,
They loved it.
that's awesome. So I have a bunch that I can go through when it comes to fundraising, but I want to make sure I'm catering this to you guys and where you're at and what you're looking to do. And kind of where you're at in the whole fundraising process and cycle. Are you just thinking about it? Are you deep in it? What questions do you have? I'm actually going to write them down, and I'm actually going to go through them in the process of kind of how I go through fundraising and teach fundraising. So please don't be shy. Come on. I know you have questions. You're all here. I know you didn't come here to waste your time at lunch. So, yes.
So if you're an enterprise company, how many customers do they normally have to have before you start seriously considering them?
Okay.
Consumer, if you're a B2C company, how many customers?
Okay. Okay. Yes.
After like a family or friends round,
Yep.
when you're looking towards kind of outside partners, angels, the conversation. Yeah, sure. Yeah. What is different after the first check
Okay.
that comes in, and what the talking points afterwards?
Okay. So when you're looking to raise from institutionals.
Yeah.
Okay.
So follow-on question to that actually. If you're raising money from a if you're raising money from a another company which is investing in you, let's say you're doing a biomedical
So it's CBC.
device,
Yep.
and you go to a Siemens or a Toshiba, and you're going to manufacture. Is it good to get into that situation better than a VC raise? VC is toxic, right? VC is going to take 30% of your company, a huge amount of equity, and you're going to get screwed. So.
Not necessarily, but yes.
Yeah, but there's a huge potential for that, right?
It depends on the VC, yeah.
Yeah. So you raise seed money, but then you realize that you really need solid money. You're making a medical device. You're going to go through FDA certification. It's going to cost you. So you say, I'll partner with this guy.
Yep.
What are the things to watch out for? And how do you select who you take that money from?
Okay.
So if you got a Siemens, a Toshiba, a GE Medical, all these guys, right?
Mm-hmm.
What are the criteria? What do you look out for?
Okay. What else? Yes.
When you're looking at financials or forecasting, what are some of the key things you look for to see in those?
Okay.
Could you elaborate on the question? Could you elaborate on the question, please?
Financials and forecasting, what are the things we look for? So I would assume, this is what I took from that question is, how do you tell your financial story correctly so it aligns with your founding story?
Yeah.
Yeah, which I'll talk through. Yes. Yes, I'll repeat it.
Fair enough. Setting expectations with investors between seed stage and Series A.
Yeah, okay.
Thanks.
Otherwise, you won't get recorded.
Setting expectations between a seed stage and Series A with investors on MRR expectations versus number of deployments versus pilots versus contracts. How do you aim at that?
Okay. Okay. What else? Yes.
Is there seasonality in fundraising?
150%.
Okay.
Investors
So can you talk a little
love
bit
their
about-
vacation time.
Okay. Can you talk about
Yeah.
what the right seasons are?
Yeah, 100%. Mark Suster actually has like a whole calendar with like red, yellow, green period of time. It's like, just go look it up online, but I'll talk through it as well. But 100%. He's one of the best people. If you guys are looking for data on early stage fundraising in general, like just follow his blog. It's amazing. Mark Suster?
Oh, SUST,
Yeah. What else? I know every single one of you has a question. I want to hear them. Come on. Yeah.
You have to have $1 billion valuation in the next number of years.
No.
Mythical unicorn.
No, it depends on the investor. Yes.
For local company,
Yes. It's to protect their money.
Yeah. What other factors are required?
Okay. Raising and US. Okay. Cool. Yes.
Whitney, do you mind repeating the questions once you hear them, not the ones
Yes,
past
I'm very bad at that. So the question was, if you're an international company raising in the U.S., what are some of the factors outside of being, doing a Delaware flip and being incorporated in the U.S. That a VC is looking for? Anything else? Yes.
How do you deal with it's a bit broad, but
Yep.
when you go pitch to a VC,
Uh-huh.
they always say you're too early for us.
Okay.
How do you deal with that question?
Okay. All right. What else? Yes. If you're too early for an investor, how do you deal with that? That was the question. Yes.
I'm in game company.
Yes.
Is there any difference between just normal investor and game investor? I think the game investor is more conservative because
It's more what? Sorry. Conservative. Yeah.
because they cannot expect which game will success or not.
Yep.
No.
Yep. So is there a difference between a gaming investor and a traditional investor?
Yeah.
Yep. What else do we have? Yes.
Tell us about the red flags when you open for investment.
Okay.
What you should avoid.
So red flags as an investor.
So back to that question that I had about who you should partner with. Just an observation. There's a company called Proteus here in San Mateo.
Yep.
They took funding from Novartis.
Yep.
I actually had an offer from them many years ago, 2010. They're still private. They still haven't gone public. They still haven't been acquired by Novartis.
Yep.
It's now, how many years later? 9 years later. And they'd already been doing this for 3-4 years.
Yep.
Why? What could be going on?
That is a limitless list. So it's a company that took a corporate venture investment, is still private, hasn't been acquired. What could be going on?
Yeah.
I mean, for all you know, the founders could just not want to take
Well,
they.
Andrew Thompson is a I don't want to say things that can be passed around, but he's
Yeah.
a different person.
Yep.
I met him.
Yep.
I didn't take the job.
Yeah.
But I would like to understand what are the criteria which cause you to not go public.
Yep.
To raise that excess money.
Yep.
You've taken money from a CVC.
Yep.
I didn't know this term was CVC. Thanks for
So
telling me.
yeah. My expertise is much more on the earlier stage, from like seed to Series A. So I can talk a little bit about the factors in that, but you'd probably be better suited talking to a later stage investor for your later stage round. So just to give you guys kind of the framework I'm coming from is much earlier stage. I'm really looking at building to the real, like the solid institutional rounds to scale. So getting to that place is, and how do you get to that particular place in fundraise?
How big is Acceleprise venture?
So Acceleprise, we're on our third fund on the Accelerator, and then we have a seed fund that specifically focuses on pre-seed and seed stage investments. And it's a $25 million fund.
Wait a minute.
Yes.
I might want to talk to you.
Yes. Outlook on remote teams. Okay.
That's not a funny question.
Okay. Yes.
So there are companies that graduate from accelerators like 500 YC,
Yep.
but there are also startups that do not.
Yep.
So if you're in the no accelerator category,
Okay.
how do you sort of pitch your startup?
Okay. Okay. Yes. If you're in the no accelerator category, how do you pitch your startup? Yes.
I have two questions.
Yes.
One is, do you invest in education space?
Okay.
And if you do, what are the business models that you've seen has been very successful?
Yep.
And then the second question is, what are the size of the pre-seed investment?
Education. Space. And then seed. Pre-seed.
So how come into that? How come a VC is in pre-seed investing? I thought that was angels. VCs didn't do that, right?
Nope, there's definitely pre-seed. Charles from so why do people do pre-seed? So Charles from Precursor was one of the first ones to pioneer it from Precursor Ventures. there's money is moved earlier because basically what used to be a seed is now a pre-seed. There's also this mango seed, which is now what used to be a Series A. So it's just like, it's basically investors have shifted quite a bit in how they're looking at investments, where it's de-risking the investment over time by doing smaller incremental investments based off of proven traction. There's been some big shifts in the market over the past couple of years, which I can talk through. But I'm going to talk through just quickly an overview of the fundraising process, and I think it'll answer some of these questions. How many of you have read Secrets of Sand Hill Road? If you have not read it, Scott Kapoor's new book. Just read it. It's like your MBA in venture, and before you sit down and talk to any investor, you should read it. It's like incredibly helpful and plays out every scenario you can look at when it comes to your equity, and very, very helpful because it runs them all the way through. So I definitely pay attention to that. And your CVC question is actually in there. So I'd actually just read that. He's a lawyer. He was like the first partner to get brought on at Andreessen. And so,
Horowitz's book also, that's a very
yeah,
interesting.
yeah.
Harder things.
Yeah. So I'd highly recommend everyone just read that book if you're thinking about fundraising, period. Just read it. Also, Brad Feld's book on term sheets. Okay, so just running through Brad Feld, founder of Techstars. So a little bit about me and Acceleprise, so you guys have that. I mentioned it briefly. So I'm an operator by background. I work with early stage founders. I've worked with 4 companies and early stage sales who've been on the Inc. 5000 fastest growing companies list. Been through 1 IPO, 4 acquisitions, and then I ran a consultancy for 4.5 years called The Sales Method, which specifically works with founders on go-to-market. And then I joined Acceleprise about 3 years ago. The programming that now rolls up under Acceleprise is basically the methodology that I developed. Acceleprise itself, I say we're one of the best kept secrets when it comes to accelerators because our cohorts are only 10 companies. We do very, very hands-on coaching. Literally, you can go on our portfolio and reach out to any one of our founders and ask about the program if you're curious about it. We've had over a 9 NPS score since I've been involved for the past 3 years. So really, really strong net promoter score. We look at 3 things as an accelerator. Their net promoter score, increase in ARR. So we actually look at true acceleration and building out the scalable model that you guys will need to put in place to actually scale your organization when you talk to investors and knowing your numbers. And then the ability to fundraise when you want to fundraise. So not every company is fundraising right after the program. We don't do demo days, we do investor weeks. So we record pitches and then actually just put you out in front of investors and set up one-on-one meetings. Investors like it a lot better. Founders like it a lot better. Increase in number of meetings has increased significantly. So our funding rates are between 40 and 60%. The top quartile of funds is usually around 40%. So we've been moving up in the rankings from the accelerator perspective, and just over time, one of the things that keeps us lower is we don't do a ton of investments, just in general because our cohort sizes are so small. I'm sorry?
Any particular markets?
Yeah, so we're a B2B fund only. So we've been in SaaS. We've been around for about 5 years. August was our 5-year anniversary. We do B2B SaaS. We'll do B2B2C marketplaces, but we only focus on the B2B side. So my background is all in B2B. I do know some about consumer because I've worked in consumer products before, but in the BD side of consumer. So I can talk a little bit about that, but my experience is really around the B2B SaaS side. So I can speak to some of the gaming questions and things like that, but it's more periphery knowledge because we look at some B2B in gaming and esports and things like that.
Can you speak to the biomedical where one makes equipment which sells to hospitals?
Yeah, so we're software, not hardware. So it's all SaaS. So, but I do know some.
Really sales?
What?
Is your last name really sales?
Yep, so that's the other thing. My last name is actually Sales, born and raised. So I had 2 last names when I was 8. I'm dyslexic. I'm like hardcore dyslexic. So you'll notice me merge words together a lot when I'm speaking, and I speak really fast. But I dropped my second last name, which was Kincannon, when I was like 8 because I didn't want to fill out STAR testing. So I've been Whitney Sales since I was like 8 years old, and I'm the only person in sales in my entire family. So very weird. But some fun facts around dyslexia is it actually teaches you to understand patterns and do pattern recognition better than most people. It's one of the strengths of dyslexia, which made me uniquely suited to be an investor. So cool, and actually early stage sales. So just to talk through, any other questions about Acceleprise before I dive into fundraising? Yes.
What's the is there times in which you guys take on cohorts?
Yeah, so we do a spring cohort in San Francisco. It's the first week in January that we start, and we went through April. And then we do a summer cohort, which will be starting 6 weeks, 4 to 6 weeks after the spring cohort wraps up. We haven't finalized the schedule for it yet. And yeah. So applications for the next cohort for the spring are actually open right now. And we specifically look at product technical founders, where one of the founders wants to learn how to sell, because it's a core competency of being a good CEO. Sorry to tell you guys, but if you didn't want to learn how to sell and you're a CEO, too bad. Cool, yes?
So you said you're looking for startups with the ARR that's scalable, but if you're
We're going to teach you how to scale it, actually. Yes, because some people are in transactional and they're moving into a SaaS model, things like that. Okay, so on the fundraising side, one common misconception that I see is that people look at fundraising as a sales funnel, when in reality it's more of a membership-based funnel. So I think it's really important to apply the right mental model to how you're framing what you're doing. And the reason I say a membership model is there's a limited number of people who can actually be involved in a fundraising round versus a sales funnel where you want to acquire as many people as possible, right? So you want to be picky, you want to pick and choose who is actually going to be a good investor for you. So when you're looking at this, which will play a little bit into your CVC element. So one of the things to pay attention to when you start your fundraising process is, everyone's heard of campaigning. So the campaigning process is essentially when you're looking at getting to know and getting yourself in front of investors. And so when you think about the campaigning process, you should usually be starting about 3 to 6 months ahead of when you're actually going to be fundraising. So going to networking events, that kind of thing. The first thing you're going to do in your campaigning process is put together a target list. So what this means is investors kind of have 4 psychographic profiles that I like to bucket. So there's technical investors. There's financial investors who come from financial backgrounds. There's operating investors. And then what's the other one? I'm drawing a blank on that one. I just went through these. Anyway, so there's 4 specific psychological profiles, and each of those investors is going to be coming at the investment process from a different psychology. So, domain expertise. Investors is the 4th one. So someone who has specific domain expertise in your market, in your segment. So even if you're a developer tool, they might have worked in your market specifically before. And they come to the business from a very different mindset. Each of them will. So a financial investor is going to come and be looking for the financial story you're telling with your business, right? So the financial model is going to be a really important piece, and how much you've de-risked around the business. A technical investor is going to be looking for your data wedges, your defensibility that's been built into the business. An operating investor is typically going to be looking at team pretty deeply. And your ability to hire and scale, and the ability to actually build that out. It also depends on the stage of investor that you're looking at, because earlier stage is going to be looking at team a lot more than later stage. It's going to be looking at the model. And then domain experts are going to be the hardest ones to get to sell to, but once you get them on board, they're the ones who can pull in a lot of other investors because they validated what you're doing in the market.
They're also get into your pants, right?
What? I'm sorry?
They get into your pants, right? They want to run your company and then move you on growth.
I wouldn't say get into your pants, but they will dig in and be more of an active investor than a passive investor. So those are, and then there's also that bucket is there's active money and passive money. As an early stage founder, I usually recommend looking for both. You want someone with deep pockets that you can come back to when you've proven out that you can do what you say you can do, and you want someone that's active that can help you, especially as a first-time founder, navigate a lot of the challenges that are going to come along with building a company for the first time. And usually it's going to be the active investor who's going to bring in the bigger checks and the deeper pockets. So when you think of putting together your target list, it's really important to put together kind of 2 tiers of target list. One of them is going to be your active, and one of them are going to be your passive. And your active investors are typically going to be smaller funds. They're usually a little bit newer funds. They're usually a little bit easier to get money, and they're going to have domain expertise in your space. usually. They're going to be those domain experts. The passive checks are going to be the big money that you guys all know about, right? And these guys will usually bring in these guys. So when you put together a list, I usually recommend 30 to 40 investors, and then you want to tier them out 1 through 3. And your third tier investors are actually where you want to start when you look at starting to fundraise. The reason you want to start there is we'll talk a little bit about when you actually start the fundraising process, but you want to work through your pitch and your objections before you get in front of your number ones. Yeah. And if you have your some yeses when you get in front of your number one, it's going to drive a tighter process for you. Does that make sense so far? Okay. So you put together your 30 to 40. The way you identify these 30 to 40 is everyone's familiar with like NFX's database, Glassdoor, and Crunchbase. Right? So you have your friends and family around that you mentioned. And then you're going to do these. Now, when you go through your campaigning process, I kind of tier out how to get intros into investors. So one of the best ways to do it is just get in person with the investors. So if they're at an event or something like that, talk to the investor before the event, not after the event. Do your research, find out what they look like, and go and find them before that event actually starts, ideally with a wingman who's not interested in fundraising, who's like very extroverted. It's a really fun hack to getting in front of an investor because you can just have someone target your friend at them and be like, hey, it's nice to meet you. Have you met this person? And then it just tees you up really nicely without you actually having to do it and force yourself to do it. So an extroverted BD person is really great at that particular tactic, and I highly recommend it. Our community manager does it for a lot of our founders. As I'm like trying to give you guys hacks to do this because it's not easy at all. So the next step is going to be, so after, if you can get in front of them, so that's why it's important to build your list, because if you're going to start your campaigning process 3 to 6 months in advance, you can start looking for events where these people are going to be attending and get in front of them. The next step is going to be other founders that they've invested in. So these are going to be, so go and look at their portfolio. The ideal introduction you can get is from one of your customers who they've invested in. That's like best of best. The other is a friend of yours who's known you for a long period of time who can vouch for you. The other is someone who's an advisor, who's another founder who's in their portfolio. It's just someone who knows you can actually vouch for you as a founder. Make sense so far? Mm-hmm. Cool. Next up is one of their friendlies. So ideally it's someone who has worked with them before, not another investor, someone who's a senior person at a company that has worked with you, a mutual connection, a founder who knows them really well, who's a little bit later stage than you, who's fundraised, who has a successful track record. So someone who knows them well, but isn't necessarily involved in your company in any way, but that you know very well. So it's like a mutual connection. Third up, and this can also be advisors. The next step is going to be accelerators. Basically, if you have an accelerator, the accelerator is probably going to be doing the campaigning process for you. If you're going through a program, that's what we do. And then the fourth one is going to be other investors. People think that other investors are great introductions. Later stage investors, so if you've talked to a Series A investor and they're introducing you to an investor at a seed stage, that's a pretty good introduction. If you're getting a seed investor to introduce you to another seed investor, that a seed investor has passed and said, actually, you should talk to this one, usually not a great introduction, because it's an indication that there is a risk profile that the investor doesn't want to take. Yes?
Where would you put accelerators in terms of a target list? Because I think one of the things I've seen as I began talking to institutional funds, saying like, it's a Herculean ask to get to 10 or 20 or 30,000 MRR.
Yep.
Or just monthly recurring revenue.
Yeah.
So then, can you also say that different accelerators can be part of that initial target list of 30 to 40 as both active money?
Yes, I would. So if you're looking for an accelerator, I would probably recommend getting in front. It should be when you're looking at your friends and family. Versus when you're going out for institutional. The reason being, as an accelerator, we actually have a major problem when someone's gone out for institutional, because we're basically putting them back out 6 months after they've already been out. So there's a lot of negative market signaling around it. So we don't want companies who have already been out fundraising. unless it's someone who, like, we have a company right now who's doing like a 500K friends and family round, but they're coming through the accelerator because they want to learn how to scale, but they're not going out to institutionals. And so, because institutional, there's a lot of, basically have to manage your reputation amongst investors. It's a very tight-knit community, and it's all managed on relationships. And so, as we've been in the system longer and longer, we know what we're like. We know the partners that work really well with us, and like we have, like Acceleprise, we have a particular reputation around go-to-market. So we know if we put our name behind something, they know that there's a business model built behind it, and our founders know how to take that company to market before we ever put them out. And so you have to look at the reputation of the accelerator you're going into, and specifically what you need help with. Like if you're not a product technical founder, you may need a product technical accelerator. If you're a product technical founder, you may need a go-to-market accelerator. So you need to make sure that you're getting in the right accelerator for you. There's YC out there, right? YC is just a big brand at this point. That's just basically what it is. So it depends on what you need. If you know you're gonna have a hard time fundraising, then YC might be a good bet. If you need help with your business, you might wanna go with a different route. And I don't typically recommend corporate accelerators. I'm just gonna put that out there. They haven't been traditionally very effective. Okay, so accelerators and then investors. You can cold email investors. I know a number of investors who actually appreciate it. They want to see the approach that a founder can take in the process, but it's typically not recommended. So one thing I recommend doing is when you put together this target list, a lot of investors are really active on Twitter. I am not, but a lot of investors are very active on Twitter, and they will speak their opinions on a regular basis. So go in and follow that investor and see what they're talking about. They'll tell you if they're interested in your space. They'll tell you what they're looking for. They'll tell you about conversations they've had. They'll tell you about red flags that they see all the time. Just go and look through like 3 months of tweets, and it'll tell you a lot about that investor and the psychology they're coming at and the things they're annoyed by right now. And that'll give you a lot in this 30 to 40 list. Just go in and follow them on Twitter and put together and go deep on them. And before you talk to them, go in and read their last several weeks of threads, because you'll learn quite a bit about that. And it's a great way to look at the psychographic of that investor and blog post. Also, most of them are on Full Ratchet or Origins or 20-minute VC at this point. So I go through and find their podcasts, like Google them and do your research beforehand if they're on your tier 1, tier 2, tier 3 list, because it'll set you up much better to know what their potential objections are going to be and how to build the story effectively for them based off of that profile I talked about, it being like a technical versus financial versus operating versus domain. Helpful? Any questions about that? Cool. So the other thing that's really important when you're looking at the campaigning process and putting together a list is knowing the types of founders that investor invests in. A lot of the larger funds that you're going to look at are typically looking for repeat founders or people who have strong DNA from one of the big like billion-dollar companies that are kind of like the Silicon Valley darling children, if you want to look at it that way. And so if you're a first-time founder coming in, know that your biggest thing that you're going to have to overcome in talking to one of the bigger name investors is you need to understand how to de-risk your own business. So that doesn't necessarily just mean traction. It may mean your ability to execute effectively. It may be your ability to hire and recruit. It may be your ability and how you're building your architecture. It's understanding your defensibility. It's all of these pieces that kind of make up, that do make up an entire picture of an investment. At Acceleprise, we primarily look for 3 core things when we're talking to founders. So one, it's founder market fit. So looking at the background of the founders themselves and what makes them uniquely suited to pursue the business that they're building. We're looking at unique vision. So this plays into the why now factor and the what do they see about the market that is, how are they going to educate me about this market? Like it's like investor tutorials where you sit down and talk to a founder and a founder starts digging in a bit about the market and you're like, oh, this is super interesting. Like, tell me more. You want that experience with the founder. So that's that kind of unique vision piece. And then the third piece we're looking at is overall market. I highly recommend doing a bottoms up and a top down analysis for investors. Do you guys know what I mean by that? Okay. So an example of this, we have a company in our portfolio that is in the aircraft space. They do they're starting with airport parking. And then they're going into aircraft services and then some optimization like operating system for external aircraft operations. One of the things they run into quite a bit is there's 40,000 airports actually in like globally. And they get a lot of objections around their market itself. The contract size they can get is significant when you look at the total services they're going to be offering. Their initial contract value is around 100K ACV, but they can get up to around 500K with some rev share built into it. So it'll actually be pretty large contract values. Their biggest competitors in the ecosystem, their market caps are billions, like they're 3 to 4 billion, and they've been around for like 20 to 30 years. But when they talk to an investor and they start going through the size of the market from a top-down perspective, they're like, this is a huge market, I don't care. So what he had to do is a bottoms-up analysis and look at how many airports were there in each size of airport and how much revenue would each size, like if they section it out into 3 core sections, could those airports represent and their TAM, SAM, and SOM. Yes?
I was just about to ask you about the TAM, SAM, and SOM.
Yes.
How does investors feel about using TAM, SAM, and SOM to tell a story about the big picture, but here's how we're going to get there?
So I actually love hearing the unique vision in the TAM, SAM, SOM. So it's like, why are you starting with this core market to like for this particular founder, why you started with aircraft parking? It's a huge hair on fire problem. Like every airport's trying to solve this problem right now. Like C-level execs are being woken up in the middle of the night to solve this problem. He was like uniquely positioned for it because he's worked with a bunch of airlines for a long time and had a deep market or deep expertise in it. But it's a hair on fire problem, and it gets him access to both the airlines as well as the airports, which now he can go in and dive deep into all the other ancillary services, and his biggest competitors aren't serving this particular need. It's all being managed in an Excel spreadsheet. So it's just a huge, like, it was a great fit for him for aircraft parking. And when he talks about this particular market and that experience, that like SAM piece or the SOM, it's going to get him into the services, which his next vision is like, okay, so I get into the aircrafts and the airlines, and now I can start going after all the other external services. And once I have the external services, I can optimize pricing around it and start optimizing all the services and start doing revenue share as he optimizes it. So that's his long-term vision, but at the same time, he's talking about the size of each of these markets and how he's going to eat more of it as he goes. Does that make sense? That helpful for everyone? Okay. So when you're sitting down, so after you've put together this list and you're starting to talk to investors and you're in the campaigning process, I highly recommend talking to investors that are slightly later stage. So one stage past where you're supposed to be. So, or where you're looking to raise. The reason I recommend doing this is, one, you're basically campaigning yourself for your next round. And at the same time, understanding the objections that are going to come up when you talk to the investors that are seed stage. So if you're looking at your Series A, you talk to your, or excuse me, or if you're looking at your seed stage investment, you talk to your Series A investors. Your Series A investors are going to help you understand, like, okay, so we know for this aircraft company, the objection is going to be market. So we really need to dig in and explain market really, really well. And so we need to build that into his deck and his story and how he tells that story to make it really strong so he handles the objection before the objection comes up in the pitch. It's the same thing if you're selling to a customer. You need to handle the objection before it comes up, and you can use it as a selling point versus like something that, like, the educating of the like investor tutorial that I was talking about. That particular piece is what's going to be really important, and you can do that and handle the objection in the process. Yes.
Could you use that same sort of strategy for like looking at different accelerators and saying like, hey, like what are the seed investors going to push back on so that when I go and meet with an accelerator, you know, I can then de-riskify? Yeah, that's like if you know, for example, like contracts, like the contract cycle is going to be really important. So you had asked a little bit around setting yourself up for your next stage of fundraising and making sure you understand the expectations around the next stage.
it's really important. That's why I say talk to the next stage investor when you're talking to your seed stage investor, because the seed stage investor is going to want to know that your financial model and how much money you're raising aligns with that next stage of fundraising plus some cushion, assuming there's going to be an economic downturn. Because we don't know what the hell's happening in the market right now. It's insane. So there's a lot of dry powder out there right now. So what you want to do is basically analyze, you're going to talk to the next stage of investor when you build out your model. So your financial story, number one, your traction tells the story of what you've done and you execute it on, and how that, like basically what you've de-risked in it and the assumptions that you've made for the next stage. And you also understand the next, like what that model should look like at the next stage of fundraising. And you de-risk that for your seed stage investor because you've already done your research going into it. I understand there's a lot to this process, but if you do it well, you basically come really well prepared, and it's a much easier process. If you try and do it while you're fundraising, it's a big old mess. So like prepares. Yes. So when, say for example, you're raising your seed stage investment, what you should do is go and talk to your Series A investors who are like friendlies, who are willing to kind of talk through your market, who are interested in your market. You can talk about where you're currently at and where you would need to be to raise your Series A, right? Like what are the KPIs, metrics, like where would they expect the business to be when you're ready to raise the Series A? There's like the $1.5 million in revenue and maybe some core KPIs that you've de-risked in the model. You probably need to show you can hire effectively on the business and technical side. There's some things around that are very generic, but they'll give you some specifics for your business. And what you're going to do is, based off of what this Series A investor has, you're going to build your financial model that of how much money you're going to be raising from your seed stage investor to align with what that Series A stage investor said you needed. So you're basically building how much you raise and why you need to raise that much, that story financially, for your seed stage investor to show you did your research and you know where you need to be in order to raise your next round, and you're raising the right amount of money. So there's a story that's been validated when you go and raise for that round. Yes?
Would you disclose if you were asked, like what Series A investor told you that?
Yeah, if they asked. I would say I've talked to several investors. Here are some of the investors I've talked to. I wouldn't say which specific one, but I'd say I've talked to several investors. Here are the investors I've talked to. Here's what I understand we need to be at for our Series A. It's also very helpful because as a seed stage investor, it lets you know that the person's done the research and they're coming to the table with like a real model, as opposed to like, we think, because so much is fluff from the founders. So if you de-risk that model and you build that model, you can build that financial story, and then the financial story of like what you've done and how you've executed and how you've de-risked the business should be the previous financial model. Right, so you have your financial model and what you've de-risked, and then you have the financial model of what you're going to build. And so showing those two and how they align and the assumptions to get you there is basically the model you're going to share. Do not share it until you're ready to have your partner meeting. Do not put it in your deck. Like Russ Huddleston from Doxon did a bunch of research with of their data at Harvard, and it decreases the likelihood you're going to fundraise if you put your financial model in your deck by about 30%. So put it in your data room and build the full model. So when you can sit down with an investor and explain it to them, you're much more likely to be successful.
Why is that?
What?
Why is that?
Because you can explain the model. They're not making, they don't, you can explain the details of the model and they can look at the algorithms and all that kind of stuff. It's just, it's research that's been proven through what Doxon did. Yeah, it's like if they have a financial model and it's like 30% less likely that you're going to have a successful fundraise in your deck. Yes?
So essentially, don't put a hockey stick in your deck.
You can put your hockey stick. I'm talking about your like Excel model.
Oh, yeah.
Yeah, and like your hiring plans and all that. Don't put it in your deck. Yes?
I'm trying to ask this question properly, but like going from seed to Series A, there's a timing period of 18 to 24 months. So, well, whatever the
Yeah.
time period is, right?
Yeah.
And in that time period, especially this is more tied to B2B.
Yeah.
Because sometimes the sales cycles are just a little bit slower.
Yep.
What kind of advice trying to figure out, like, what advice or how hard it is for a lot of B2B companies to be able to capture whatever they need to capture, to be able to get that Series A capital? How long does that usually take?
So That's a very interesting question, and it depends on, so someone had asked the number of customers you need for enterprise and consumer. There is no silver bullet. So I'm just going to say that. The big thing is to understand the risk of your market. So you asked about education. We do invest in education. The issue around ed tech specifically is the sales cycle that you see and the contract value. So typically one of the things we're looking at is how long does it take to close that customer, the first customer, the third customer, the fifth customer. So is that sales cycle decreasing over time? And is the contract value increasing over time? So that shows learning and a de-risk of that investment and a scale, because especially in the ed tech space, it's a very well network space. It's similar to the investor ecosystem. It's very relational. And so if I know as you start to get traction in the education space and you've penetrated that, if your contract value is high enough, it's going to be easy to get the virality going. But you have to get that going and do the proof of concept and get through. And so an investor is going to be looking for those pieces when they look at that particular market. So you need to look at those pieces around your business to understand the risk profile of your business and what are the things that are going to be objections about your particular business. And so there's no, there's no silver bullet here. But you need to look at, for example, are you selling to SMB? Are you selling to mid-market? Or are you selling to enterprise? If you're selling to SMB, what you're looking for is what does the onboarding flow look like? What does the churn look like? What does the CAC look like, right? So you're looking at the de-risking of the investment around those. And how long are the contract values increasing? So we have a company right now, it's kind of like a business in a box. Think of it as Shopify for service businesses. They've sold 300 customers in 8 months. They're over 30K in MRR. But their major objection they receive is around defensibility. And so they have a model that's built out for that, but they can't execute on that model until certain things are delivered upon, until they have a certain volume of customers. And so they need an investor. They need to build out their financial model to tell that particular story, and have an investor who understands the problem really well, and what it's going to take to get there. So you have to look at the profile of the investor. You have to also look at the profile of your individual business and what's needed. If you're in the mid-market space, what you're looking for is an increase in contract value. You probably you need a really core group of customers. So it needs to show that you've had focus on a segment of an ICP, so an ideal customer profile, to show that you've actually penetrated a group of customers and you're growing within that group of customers. If you're enterprise, you need to, usually you can get you need to show a POC converted, at least one POC converted, and a strong pipeline, and ideally a couple other POCs in place. And ideally that POC that's converted is a really strong customer advocate, is a strong referral. So that's for pre-seed to seed. It just depends on how complex your tech is and the founder background, honestly, on how much you can raise and how well you tell your story. So that was okay, so what is the difference between your first round and your institutional? When you're looking at your first round of funding, usually your friends and family round is coming together to get you to your institutional. And what that means from an institutional perspective is you're usually looking for indications of product market fit. Sometimes if you're a repeat founder, usually your background should be good enough to show indication it's a product market fit. If you're a first-time founder, you need to show it in traction, usually in traction and some type of defensibility. So some type of data wedge, some types of scalability, some type of viral loop in your product. But you need to show indications of product market fit and that level of defensibility. And then have a big enough market you're going after, and be able to tell that story effectively. The friends and family round, it's usually just it's a round to get you to where you need to be to get that institutional round if you need capital to execute on that. I usually recommend starting with friends and family before going out to your institutional for, probably 2-3 months. The reason being it's going to help you flesh through a lot of your objections and your storytelling too. in the same way that Series A will. The Series A is going to help you get to your model. The friends and family is going to help you get to like just any gaps in your pitch or things that don't make sense and kind of work through your languaging for an investor. They'll also be great for helping you seed your customer base anyway. So I always recommend that. So you're going to do that as part of the campaigning process in general. But the major difference is you need to tell a very tight, clean story with institutional investors. You need to have a stronger market story. A lot of friends and family are going to invest because they like you as a founder, where institutional investors will like you. Yes, they need to like you as a founder, but you need to have founder market fit. You need to have a unique vision. You need to have a why now. And you need to have a product and market that your customers love and indications that they love it. I'm not sure if that answers your question, but I can talk more about that if you would like. Does that answer? It was your question, right?
Yeah, it was a little bit like up to the first check and then what the conversation topic is after the first check as well, too, because I think you received a lot of kind of unique rejection after the first check. Mm-hmm. Okay, now you have one believer. How does that?
So friends and family, they're like those checks will come in at random times. It's just like it's when you need to raise it, or if someone like opportunistically comes in with a check. Institutional investors, you need to start. So in this as well with your target list, I forgot to mention, start with your lead investors. So lead investors are people who will write the check and set the terms for the round, so meaning price it. And they'll set the terms for the next group that comes in, for the rest of the people who follow to fill out the round. So that lead check is the hardest check to get, but once you get the lead, it's a lot easier to fill out. And usually just like focus your conversations on finding lead investors, and you can tell who, like it's listed in Crunchbase who leads. So just focus all your conversations in the early days around your lead check. And then if you find friends and family who are willing to like come in if someone leads it, that's great, but half the time they don't end up coming in. They'll say they'll come in, but they won't end up coming in. So I just recommend just focus your conversation on who you're lead investors to start, because everyone else is a waste of time until you have that, unless you're trying to flesh out your story. I don't know if that is also helpful. Okay, cool.
Rule of thumb for like what qualifies as a lead investor? Is it like half of what you're raising for? Is it like?
It's the person who's going to set terms for everyone else. That's it. One thing that's really important to pay attention to, it's very smart for all you guys to want to maintain as much ownership of your company as humanly possible. I totally get it. However, if you're raising for venture, if you're raising for a venture model, you need to understand the incentives of an venture investor. Venture investors have a financial model that they need to own a specific portion of the company within a specific price range in order to deliver to their LPs, because we also have investors who we have to deliver for. And so if you're raising too small of a round where we can't own enough of your company to hit our financial targets, we won't even, like, it doesn't make sense for us to even look at you. Well, it's an immediate pass. Yes?
I see, like, some seed funds mentioned that they're targeting 7-10%.
Yep.
And then when you see seed round close, there's a company that has 4 of them in that round.
Yep.
So how does that manage?
That usually has to do with, it was a competitive round. So they were able to get a lot of investors interested, and so the investor is just trying to carve out a piece of it for themselves, so and ideally, usually what that investor will do is buy pro rata rights for their next round. So they'll buy a percent of ownership in the next round of financing. So say, for example, we might put in $150 to $250K check, but we're putting in that check so we can buy pro rata rights to see how this company executes on their targets. To put in money later and buy a larger percentage when that business has been more de-risked.
So to try to get to that 7 to 10%, but if all 4 of those seed funds are trying to do that, how?
You as a founder get to choose. Okay. Yeah, which is why active investors are active, and they're usually ones with smaller funds, because they are earning their rights to invest later with sweat equity. Like we at Acceleprise have gotten rights in most of our companies. when they've raised future rounds, even in their like Series Bs, if we wanted to for SPVs, because they want to keep us in. And so that's why I say get an active investor, because an active investor will work for, there'll be sweat equity versus just a check. But you want deep pockets too to go back to, because it's going to make it a lot easier to fundraise later down the line. They might carve out 50% allocation for you, or 50% of the round, and then just you have to fill out the rest. Does that make sense?
Is pro rata synonymous with all with discounts?
Pro rata rights are the ability for an investor, it's a guaranteed right for the investor to invest a certain percent in the next round, whatever the valuation is. So another lead investor will come in, we have pro rata rights to invest 5%, we can take 5% of that round regardless of whether you want other investors to come in or not. We have legal, contractual rights to that, yes.
What are the most attractive deal terms to
for early stage investment, like seed, like for example, like straight equity swap or convertible note, post money saved?
It's across the board. It depends on how the terms are defined. Like legal contracts, there's lots of different, and depends on how the round's coming together. I will introduce GSV Labs to an amazing lawyer who will come in and talk about all this for you guys. If you guys are fundraising, Aravinda is amazing. So I will introduce you guys to her. And she will detail out all the legalese around a fund and what you should negotiate, what you shouldn't negotiate, if certain things are in a contract together, what they mean. So I would, and why to do a note, why to do post money versus pre money, and why investors do it, and when to do it. She'll explain that a lot better than I can. Cool, yes?
How do you get the chance to talk to the Series A investor in order to line up?
This is what networking is for. Build out your network. Like always be having your fundraising hat on. You literally never stop fundraising, even when you're not fundraising.
But it seems like
so when you are like talking to, like you can say, hey, we're looking to raise our seed round. I'm interested in talking to some later stage investors to understand a little bit more about where we're going to need to be to raise our Series A. Would you be open to sitting down with me for 15 minutes? Ideally, go and do that in person at an event they're talking at. And do that whole, have an extroverted person go and introduce you.
Seems like the Series A investors don't like to talk to handsome looking founders.
That's why you have a friend who introduces you. Yes.
You mentioned earlier, I think it was the pre-seed of the seed was a $25 million fund.
No, it's a microfund. All I was saying is, so we're a microfund.
Right.
Microfunds are either a pre-seed or seed. It could be either one. Usually they do both. And they're earlier checks, and they usually have larger partners that they work with that they bring in on the rounds.
And in terms of what's the average size of investment? And what is
it totally depends on the investor. You've got to go look up the investor on Crunchbase.
Oh, I thought I was talking more about.
Oh, Acceleprise. So we're 250 to 750.
Got it.
Yeah. Depending on the stage and the valuation. Cool. So CVCs, who and what to watch out for. So CVCs, one of the big things you're looking for with a corporate venture partner, usually they invest at Series A. They're starting to move earlier, but be very wary. The big thing that you're looking for is you don't want someone who is going to block your ability to work with their competitors. And where if you're working with them, ensuring that the competitor would still work with you, even if that a person is an investor in your round. Because you don't want their money to impede your ability to go to market. Because if they do that, you're basically cutting off your market cap. And then they'll put in some exclusivity stuff into it. Like they want, like, what are going to be their expectations around how you work with them? Are there expectations around how you work with them, or is it just money? So you need to understand and really vet out what their expectations of that relationship look like, and then make sure you have someone go through the contract in a fine-tooth comb, because there are things that will tie together in the contract that you may not necessarily, in standing alone they're fine, but when they're included together it can cause a lot of issues. Okay, financials and forecasting. Did I answer that question for you around telling the story with your financials?
Yeah, but maybe if you can just give some detail too on like the kind of what stages of funding, you know, what are kind of like the key points that they're investors are looking at in financials, whether it's
Okay, so Point Nine Capital has at each stage they have back of the napkin each year that will tell you like how many customers, founder background, like just average data. They do it every year, so I'd highly recommend looking that up. Point Nine, yeah, European investor, now they're investing in the U.S. They're great, but like the big guys in Europe. But they do a back of the napkin analysis every year that just tell you like how the rounds are changing. Also, CB Insights is another one I would suggest everyone go look up. The reason I'm recommending this is the data changes constantly. Rounds are changing constantly. Also, people talk about how there's more money being invested in venture than ever before, but there's more money late stage. It's actually eating a lot of the early stage. Like there's less early stage rounds actually being funded. So it's actually harder to raise in the early stage than it used to be, but there's more dollars going in. So a lot of it's to repeat founders. First-time founders, it's less. So it's just like, it's things to understand about what's going on in the market and being sure you're staying on top of. From a financial model perspective, when you're building it out, what you need to understand, and I talked a little bit about this, is you need to understand what are the assumptions you've built into your model and why have you made those assumptions? Because if you have a financial investor or a data-driven person, they want to know that you understand the assumptions of your business and what has to go right in order for you to be successful and what could go wrong in order for you to fail. And if you understand those pieces and how you're mitigating for those risks and how you're going to prove it out, that's basically how you want to answer those questions when you're talking to an investor. And that's where they get interested, because it shows that you're actually ready to be invested in, because you understand your business and the triggers around your business really well. Cool? Does that answer your question? Cool. All right. Setting expectations between seed and Series A. Did I answer that question? More on that one?
Pretty good. I mean, distinction between setting kind of MRR or ARR expectations to the earlier folks.
Yeah.
Because the later stage folks really aim at like $1.5 million ARR, et cetera. But
sometimes not. It's like expectations.
Right.
So you might have like, it may be POC. Like we have a company now who has like 410 in ARR, but the contracts are actually signed for 1.3. So they have scalable revenue built into them. So we can actually go for a bigger round than someone who just has 400K in ARR. Plus he has a contract with a company that's going to roll them out across like 400 companies. So it's like that, those pieces kind of make him a later stage investor. So you just need to understand, like you need to understand the path to revenue and make sure you have a very clear path you can tell your investors and how you get there and what it looks like and what it's going to cost for you to get there.
Is there any danger in setting the expectation revenue-based versus number of executed pilots or engagements, et cetera?
So one thing to understand in an early stage company is you're not optimizing for revenue, you're optimizing for use cases and potential growth. So your traction KPI, like people talk about revenue being the target, and revenue is great because your dollars go further and working capital is cheaper than venture capital for you guys as founders. However, you as an early stage founder, you're not optimizing for revenue, you're optimizing for use cases that prove out that you have product market fit in the early days. Right. Later, you're building scale upon that, on top of that. But right now, you're optimizing for use cases and de-risking the company and understanding like what does the CAC look like? What is the potential contract value I can eventually get? Where am I going to scale up into that? How am I going to eat more of the budget that I'm going after? How do I move across the organization or up the organization? And so you need to build out the story so that your investor really understands that and it's very clear. And you have a path to that. Make sense? And so you need to understand from the investor what that looks like. And I can't give, again, there's no silver bullet. You really have to understand your business. Seasonality, summer and winter, don't do it, basically. And holidays. Also know all the Jewish holidays. Because a large percent of the investors in the Bay Area are Jewish. International company raising in the US outside of being incorporated. So US customers. Make sure you have a strong base of US customers who love your product. Contract value within those. If it's an international company that's expanded to the US, that's not as good as a fully wholly owned US company that you've sold in the US. That so if you have a company that's that has operations in Singapore and then you're selling to the US entity, it's not as good as just selling to a standalone company, because it shows that you can execute in the US. And then you basically assume that the investor is going to discount your international revenue by about 70% to 80%. So if you want US investors, you basically need to start from scratch when it comes to building out your traction and de-risking the investment. Yes?
What if it's a US company that's selling to clients overseas? Is it different?
So you have to look at the investors you're going to be pulling in. If the investors have operations or it's money from where you're selling into, you're usually in a good place. So we have a company right now who has customers in Singapore, and she was an executive in Singapore for years. And so she's actually really well known in Singapore. So we're actually putting her out for her seed round in Singapore versus the US, because it just makes a lot more sense, even though she's owned in the US. And she's really attractive to a lot of investors in Singapore, but the US, she's not quite attractive yet. So it's looking at the profile of where it's going to be easiest to raise based off of your customer base. If you're trying to break into the US and you want US money, usually you want US customers, because you need to show that you can expand within the US base. But if you're taking Chinese money or Singapore money and you have customers in that market, that's usually a good validation for those investors. Seasonal valuation. What else do I have here? Oh, pitch for a VC when they say it's too early. So what that means typically is you need to button up your story and your financial story and be more prepared, so that the fundraising story that I was talking around, what you de-risk and what assumptions you've made, you haven't de-risked it enough for that investor. And so you need to build out your story well, and you need to understand the objections of your own business, on what could go wrong in the business that's turning off the investor, and how do you de-risk that for them. You also need to make sure that you're going out at the right time. So just because you need money doesn't mean you should be going and talking to institutional investors. You get 6 months and you get one time going out, and then you basically have to hold again for 6 to 8 months before you can go back out. So make sure you're going out when you have a story to tell and it's the right time, and go and shop it a little bit in the campaigning process. That's why you build those relationships and you talk to a couple investors, see what the appetite looks like, see how good your story is, and see how many objections you're getting. And if it's not good, don't go out. Come back and go back out. Raise a small friends and family round to bridge you. But if you go out and you're out for 8 months, you basically become a stale deal and unattractive. And then you have to hit some major milestones before you can go back out, because it's all reputation management. Red flags as an investor. So a company saying things that aren't true. They say their competitors are a certain way, or their product is a certain way, not understanding their competitors really well, not understanding why something's a saturated market, not knowing all the other startups in the ecosystem that are going and pitching them, or pitching to the same investor the same story, and how they're different. Someone who's naive, arrogance is a big turnoff for me personally. Investors really want someone who's coachable, especially if you're a smaller, if you're a micro investor like me. I want someone I'm going to be able to go deep with, because we dig in as an investor and really go deep with the team, and we want someone who's going to go deep with us. Some people just want to put in money and just know it's a good investment and let the money just ride. That is not who we are. So you need to understand the profile of the investor you're talking to and do your research. If someone has not done the research, I can tell. I can always tell if someone hasn't done the research when we talk to them. It drives me crazy. pronouncing investors' names wrong is a big one. It's bad. It happens all the time. People's funds wrong. Not understanding like what the investor looks for, because most investors write it up on their blogs. So those are some things. Not understanding the risk of your business. So an accelerator versus a non-accelerator. So the thing if you're a first-time founder who hasn't gone through an accelerator, which is totally fine, you need to have your story buttoned up and understand how to tell the story effectively. It's just all the stuff that we're going through now. An accelerator is typically going to practice this with you and go through it in detail. So you just need to make sure you have a support system to do that with you and run through it with you, and people to help get you in front of investors. It's not, I mean, in the end, you're sitting down with an investor one-on-one. An accelerator's not sitting in there with you. And so it's more about making sure you understand what it takes to fundraise, and you have the network to help you fundraise, and you understand the story you need to be telling and how to build it out effectively. And there's a lot, like, you're in the valley, so all this shit's out there. Like, we're all out there talking all the time, and there's people out there to help you. So, just go to the talks and listen. And like Growth Financial will help you with your model, that kind of stuff. Yes?
How do investors see accelerators that invest in you versus accelerators that don't invest and add money or take equity? So like essentially free accelerators.
So I personally don't like them. They're big in Canada, I know, for example. And I don't want to knock them because some of them are great. Like some of them can be really, really helpful. But I'm like personally not a huge fan because I feel like you can go through and get money. So like why wouldn't you go through a group that would give you money when so there's a little bit of a market signal there. But it also depends on the accelerator. Yeah. And you really want to look at the managing director of the accelerator themselves. Because that person's really the brand that it's being built behind. Anything else?
Please give a really round of applause for
You didn't answer my CVC question.
So I did. It's CVC, who and what to watch out for. You were on your phone. I did actually answer it.
Yeah, I don't know how long you can stay if anyone has any other questions. If you have any questions about GSD Labs, please find me.
Yes.
Or one of my colleagues. I'm Kate, and we're happy to answer any questions. But thank
Yes.
you so much for being here.
It was my pleasure. My email is acceleprise.vc. You can find me on LinkedIn. I'm in a pink shirt, and I'm actually a brunette in the photo. Oops. And then my Twitter is the sales method, but I don't really tweet all that often. It's mainly Acceleprise stuff. So.
And we'll send out the live stream as well if you are looking at the event. So everyone can get that recorded.
Cool.
What
Yes.
was your email?